Isaac Newton famously said, "To every action, there is an always opposed and equal reaction." That turned into, for every action, there is an equal and opposite reaction. That quote holds as true as ever when carriers' GRI met the market this past week. This is this week's Freight Market Update. Today is January 15th. I'm Mike Emiliani, and let's get right into it. Global trade policy was dominated by a significant escalation in U.S. tariff actions and ongoing efforts elsewhere to manage trade disputes and expand market access. The most consequential development was the Trump administration's announcement of a sweeping 25% tariff on any country trading with Iran, immediately raising tensions with major economies and attracting threats of retaliation, especially from China. This marked a continued hardline U.S. approach to trade policy amid geopolitical concerns and has occurred alongside domestic legal challenges over the authority of past tariff measures. In parallel, Europe and South America advanced a long-gestating EU-Mercosur free trade agreement, signaling a major tariff-reducing integration after decades of negotiations and reflecting alternative trade cooperation amid rising protectionism. European efforts to strengthen commercial ties with India and resolve Beijing EU industrial disputes over electric vehicles further underscored a multipolar trade landscape navigating both tariff pressures and strategic partnerships. Switching gears now to this week's ocean, air, and freight markets. China-US West Coast spot rates fell sharply week over week, sliding back into the 1850-1950 per FEU range. Early January GRIs have effectively washed out as demand failed to materialize, leaving carriers with little pricing power. While most carriers are signaling another aggressive GRI attempt for the second half of January, targeting rates north of 3,000 FEU, early market behavior suggests limiting staying power at those levels. On the East Coast, rates to the East Coast followed a similar trajectory, easing week over week as volumes remain muted. Although carriers are aiming for a 4,000, possibly 4,000 plus per FEU later this month, competitive pressure and weak fundamentals are already undermining these efforts. As with the West Coast, any mid-month increases are expected to face rapid erosion. Shifting gears now to the why. Well, why did the rates take the shape that they did this week? Well, there's about 5 reasons we can really point to, starting first with simply lack of volume support. Post-holiday demand had failed to rebound, with January volumes tracking similarly to December lows. Next, we're seeing GRIs issued without fundamentals backing them. Carriers pushed significant GRIs at the start of January, but most of these increases have already disappeared. The market is now seeing a familiar pattern begin to emerge. GRIs announced, then there's some stickiness, followed by a rapid rollback. We're also seeing some divergence in how carriers are pricing. While most carriers are holding firm on announced mid-month increases, from what we've found, at least one smaller carrier is offering sub-2,000 rates deep into the second half of January. In doing so, they're signaling low confidence in demand and pressuring the broader market downward. Next, blank sailings, artificial capacity demands. Blank sailings and vessels taken out of rotation are tightening space temporarily. But this is a supply-side maneuver, not a demand-driven congestion. Once capacity normalizes, rates are likely to soften again. And last, the pre-Chinese New Year timing mismatch. Unlike stronger years, January demand is not strong enough to support pre-Lunar New Year pricing. As a result, this is forcing carriers into repeated GRI attempts rather than a single sustained increase. Now, looking ahead, what can importers and businesses expect in the weeks ahead? Importers and businesses can expect continued volatility through the second half of January. While carriers will attempt to push rates higher ahead of Chinese New Year using GRIs and blank sailings, underlying demand remains too weak to sustain those levels. Market indicators point towards rates drifting back towards the low 2,000 range by late January, particularly on the West Coast, with the East Coast lanes following closely behind. Looking into February, pricing is likely to stabilize around Lunar New Year before resuming downward pressure as capacity returns and volumes reset. Down in the description below, you can find some links that we liked reading this week and that helped go into this week's update. You can also find the link to Freightright's True Freight Index in the description alongside those links. Obviously, we recommend save it, bookmark it, tell a friend, your colleague, your boss, anybody that'll listen about it. It's a good tool. It's a great tool if you're looking to know exactly what it costs to ship today. And that's all for this week's market update. We'll see you all next week.